Welcome to Market Blaster, where we blow apart the stock market and put it back together so that it makes sense for you. I'm Forbes Markets editor John Dobis. Today we're going to be going through the mud with stocks. That's right, stocks kind of broke down and got caught in the mud 2 weeks ago. That is, caught below their 200-day moving average. And we're going to get our mullets all groomed nicely, get in the truck, take our shirts off, and go run around and see what we can do. Here you go. Here's what I'm talking about, the mud. We broke below the 200-day moving average for just one day in early June. Rose back above it. Looks like possibly a reverse head and shoulders formation. That's a nice little reversal pattern, but we don't know quite yet. A little more information on that in a second. But you want to see stocks above the 200-day average. Above it is bull market territory. Below it, bear market territory. Kind of a rough and fast guide. But in any case, we're above it now, and we're above the 10-day average. Here's going back to last summer. You can see we slipped below the 200-day average, and that was not the end of the fall. We kind of spent 3 months before we got back above it again. So it has not played out as badly as we had it last summer, this summer yet, but there's still time, right? Well, we had some great analysis today on stockcharts.com, looking here at what happened last fall when stocks broke out on October 3rd and what's happening today. So back on October 3rd last year, when stocks broke out, you also had treasuries, that is government bonds, breaking down, yields going higher. And we don't have that quite yet. The dollar broke down because the risk-on, risk-off trade, when the dollar goes up, it's risk-off, stocks go down. And oil broke out from $75 per barrel, ran eventually to $110 last fall. Well, looking at yesterday and today, one of the great albums, the early albums by the Beatles. Now we're looking at yesterday and today, what's happening in the market though. Not quite soup yet. Be careful here with this market because the S&P is still below resistance, the SPY, the ETF that tracks it. The TLT, which is the ETF that owns 20-plus year maturities of government bonds, it's still above support. Yields are still pretty darn low there. And the UUP, which tracks the US dollar index, that's still trending higher. And oil is still going down. So you don't have those conditions yet that really conspired to help the markets move higher last fall. Oil, treasuries, and the dollar do not bode well for stocks in the near term. Looking at the year-to-date performance of some of the sectors in the S&P 500 index, the S&P itself is up 6.4% year-to-date. The energy spider is down 6.3%. It's the only sector fund that is down year-to-date. That makes a guy like J.R. Ewing very angry. Well, he's not very angry right there because that's Larry Hagman. Larry Hagman, of course, who played J.R. Ewing, has been collecting royalty checks for the last 25 years from Dallas episodes that have run in Germany, Japan, and the UK. And he's probably got money to burn. And of course, Dallas is back on the air. But energy and financials have been the boys that have been hit the hardest since the market topped out April 2nd. To be expected, there's very cyclical stocks. Energy down 11%, 11.5% for financials. This guy's been a poster child for the financial sector. JP Morgan Chase and Company's CEO and Chairman Jamie Dimon. He was before the Senate Banking Committee on Wednesday defending, or at least trying to, JP Morgan's risk control or lack thereof in regards to its trader in London, which became known, Bruno Ixel, known as the London Whale, who lost $2 billion, maybe more, in bum trades that would have, Dimon said, gone up if the market had tanked, if we had a bad credit crisis. But we didn't have that bad of a crisis, and they're out of money. But anyway, here we have something that we've referred to many times here. Dividends really do cushion a portfolio from harm. In the extreme, you've got Duke Energy up 10% year-to-date. Duke is a big, fat, yielding utility stock. You've got the market overall down 6.3%. Intel down 6%. Intel pays a pretty fat dividend. Johnson & Johnson, Kraft is about even money. Apple, of course, pays a little bit of a dividend. Their stock has caught, a little bit of a break. Gravity's not pulling it down so much, riding the 10-day average higher, looking to get it back above the 50-day moving average. Apple may have some new products on the horizon, some new TV stuff. They're making their own maps, for gosh sakes. Run by, used to be, founded by a college dropout. Some of the best companies around, or the most successful ones, have been founded by college dropouts. You've got Bill Gates over there with Microsoft. Of course, Zuck with Facebook. You can argue about how successful it is, really, but it did very well for him. And this guy right down here, Michael Dell, Longhorn, UT, 1984, dropped out of school, to go pursue the Dell model full time. Dell now is paying a dividend, 8 cents per share. Times 4 is 32 cents divided by the stock price of 12.20 something. You get about a 2.6% yield out of Dell. Of course, Dell just tanked about a month ago after some bad results. So be careful catching that falling knife. But at least now you get paid to wait for that stock price to come back and get paid 2.6%. Microsoft, you're getting a 2.8% yield right there. So Dell is kind of quickly catching up to where Microsoft is in terms of being an income-producing tech stock. Failbook, Facebook, since going public on May 18th at 38 bucks per share, this thing is down. It fell as low as 25.50, closing Wednesday at 27 and change. Facebook down hard, down. That's a 33% drop from its IPO price. Pandora. Oh, Pandora just got smashed more than 5.5% on Wednesday. A lot of talk. Look at this. This is from its IPO last June. The stock is down now below $10 again. If you want to, I haven't. You listen to the ads. You could pay $3 per month, 36 a year. I don't. I guess a lot of people don't. Some analyst was talking up the potential of Songza. There's Last FM, you've got Django, you've got so many different places to turn for free music on the web. But Songza is coming on strong in the Apple App Store. So there's a lot of competition out there. You know, who's going to listen to Pandora? Greater question is, who's going to stick around for Sirius? I pay it actually, it's about $150 a year. If I could figure out which month of the year I'm getting billed on my credit card before it gets billed, I'd cancel it. But so far, for the last 3 or 4 years, I haven't done that. Sirius, going back down to $1.82, lowest it's been in about a month. So you've got a lot of stuff going on out there. The market still wants to work its problems out a little bit more. We could get a bounce here, but more likely, we're going to have a little bit of a volatile period. We've got the Greek elections coming on the weekend, Fed announcements the week after. You've got the G20. You've got a whole bunch of meetings, and the future of Europe will play a big role in how this market turns out.